Picking good stocks under $10 is not about hunting for lottery tickets. It is about finding real businesses whose share prices happen to be low, while their long-term potential is still promising. In this video, the goal is not to give you hype or quick flip penny stocks, but to teach you how to think about cheaper shares so you can build a smarter, more resilient portfolio. Instead of naming specific tickers that could be outdated by the time you watch this, the script will walk through 5 types of companies that often trade under $10 and can offer attractive opportunities when researched properly. Before looking at any category, it is important to clear up one dangerous myth. A low share price does not automatically make a stock cheap. A company can trade at $8 per share and still be wildly overvalued relative to its earnings, assets, and prospects. Another company can trade at $50 or $100 per share and be reasonably priced or even a bargain. The real question is not, is this stock under $10? But what am I getting in terms of earnings power, balance sheet strength, and future growth for each dollar I put in? Stocks under $10 fall into several broad groups. Some are smaller companies that have always operated at a modest scale. Others are former market favorites that have lost favor due to temporary setbacks or full-blown crises. Still others are speculative ventures with little revenue and big promises. Your job is to avoid the fragile names and focus on those with real businesses and understandable paths forward. With that in mind, here are 5 types of under $10 stocks that can deserve a place, in moderation, in a well-built portfolio. The first type is the steady cash flow business that the market has simply grown bored with. These are companies that do unglamorous but essential work, managing infrastructure, providing specialized industrial services, or selling niche products to recurring customers. They often produce predictable revenue and free cash flow year after year, but because they are not in trendy sectors, investors may assign them low valuation multiples. When a stock like this drifts under $10, it can represent a chance to buy a healthy business at a discount, especially if its balance sheet is clean and management is returning cash to shareholders through dividends or buybacks. To spot this type of opportunity, start by screening for stocks under $10 with positive earnings in most of the last 5 years and healthy operating cash flow. Look for modest but stable revenue rather than explosive growth followed by collapse. Check whether the company pays a sustainable dividend. A reasonable payout backed by consistent cash flow is a positive sign, while an unsustainably high yield can be a warning. Read recent annual reports or presentations to understand what the company actually does and why customers keep coming back. When you find a firm whose products are needed regardless of economic fashion, you may have discovered a quietly attractive holding. The second type of under $10 stock worth considering is the cyclical company that is temporarily out of favor. Cyclical businesses are those whose profits rise and fall with the broader economy or with a particular commodity cycle. Think shipping, construction suppliers, certain manufacturers, or resource companies. During downturns, their earnings shrink, investors grow pessimistic, and share prices can fall into single digits. Yet if the company has survived multiple cycles before, carries manageable debt, and maintains a competitive position, a low share price during a gloomy phase can be an opportunity rather than a warning. Analyzing these companies requires a longer-term view. Instead of focusing only on current earnings, study how the business performed during previous recessions and recoveries. Did revenues bounce back strongly when demand returned? Did management avoid taking on excessive debt at the top of the last cycle? If a cyclical company is trading under $10 but has a history of much higher profits and share prices in normal conditions, and if its fundamentals are intact, buying during the trough and holding patiently can be rewarding. Just remember that timing is uncertain. You may need to endure more volatility before the tide turns. The third type is the small but profitable growth company. This is often a lesser-known firm in technology, healthcare, software, or specialized services that is still early in its expansion. Because the company is small, its share price may naturally be under $10 even if the underlying business is performing well. The key is to distinguish between genuine growth and hype. A promising candidate will show rising revenue, improving margins, and evidence that customers are adopting its products beyond a tiny early niche. When evaluating a potential growth stock under $10, begin with revenue trends over several years. Look for double-digit percentage growth powered by real demand, not one-off deals. Examine gross and operating margins to see whether the company is gaining efficiency as it scales. Check whether research and development spending is focused and whether management talks clearly about its strategy rather than using buzzwords. It is also crucial to assess dilution. Young companies sometimes issue many new shares to fund operations, which can erode existing shareholders' ownership even when the business itself is growing. A small, well-run growth firm that keeps dilution under control and marches steadily toward consistent profitability can be a compelling addition in this price range. The fourth type of stock under $10 that can make sense for patient investors is the turnaround story with improving fundamentals. These are companies that ran into serious trouble, perhaps due to mismanagement, a failed product launch, or an overly aggressive acquisition, but have brought in new leadership and are executing a realistic recovery plan. In the early stages of a turnaround, the market often remains skeptical and keeps the share price depressed. That skepticism is justified much of the time, because not every turnaround works. However, when tangible progress is visible on the balance sheet and income statement, the gap between perception and reality can create opportunity. Identifying a credible turnaround begins with management. Has there been a change in leadership? And does the new team have a track record of fixing similar problems in the past? Next, look at debt and cash. Is the company paying down what it owes, refinancing on better terms, or selling non-core assets to strengthen its position? On the operational side, are unprofitable segments being closed or sold, while core lines show improvement? If you see sustained positive steps over several quarters, not just promises in press releases, a sub-$10 stock that the market still distrusts may gradually re-rate higher as confidence returns. The fifth and final type is the high-quality international company that happens to trade as an American depositary receipt or on a smaller exchange with a low nominal share price. Many solid businesses outside the United States have share structures or currency conversions that put their stock under $10 without saying anything negative about their value. Some operate in regions with growing middle classes, developing infrastructure, or expanding digital economies. For investors willing to understand foreign markets, these names can add diversification and growth potential. Researching international under $10 stocks comes with extra homework. You need to consider political risk, currency risk, different accounting rules, and local competitive dynamics. Look for firms with straightforward business models, transparent reporting, and some level of global footprint rather than opaque operations in highly unstable environments. Pay attention to whether shareholders' rights are respected, such as through reasonable corporate governance and dividend policies. When chosen carefully, a few of these names can balance a portfolio that is otherwise concentrated in one country or region. Across all five categories, a few common rules should guide your approach. First, never build your entire portfolio from low-price stocks, no matter how exciting they seem. Treat them as a side dish, not the main course, with the bulk of your long-term money in diversified funds and stronger, larger companies. Second, always check liquidity. Avoid extremely thinly traded shares where buying or selling even small amounts moves the price sharply. Third, be wary of stories that depend on perfect execution or one dramatic event, such as regulatory approval, a single huge contract, or a hoped-for acquisition. The more moving parts have to go right, the higher the chance that reality will disappoint. Risk management is essential when dealing with under $10 names. Limit how much money you allocate to any single idea, perhaps setting a small percentage of your overall portfolio as a maximum position size. Consider using a mental stop rule, not a rigid automatic stop loss that might trigger on noise, but a clear level at which you will reassess the thesis if the stock falls beyond it. Ask yourself before you buy how you will react if the price drops by 20 or 30%. If that thought makes you feel sick, your position may be too large or too speculative for your comfort. Emotion can be your biggest enemy in this part of the market. Because cheaper stocks can move dramatically in short periods, it is easy to get swept up in fear when prices fall or greed when they surge. This is why having written criteria for buying and selling is so valuable. When you can say, I am buying this because it is a stable cash flow business temporarily mispriced, or I will sell if debt increases and revenue continues to decline, you anchor your decisions to facts rather than feelings. The market will always generate noise. Your plan needs to filter signal from that noise. Due diligence also extends beyond numbers. Spend time reading what management says and, more importantly, whether their actions match their words. Watch for red flags such as frequent changes in strategy, constant reshuffling of executives, or vague explanations for persistent problems. Check whether insider ownership is meaningful. Leaders who own significant stakes are more likely to think like long-term partners than short-term renters. A pattern of insiders buying at market prices can signal confidence, while heavy insider selling, especially after promotional announcements, can be a warning. Pay special attention to dilution and share issuance, particularly in smaller companies. A stock might trade at $5 and appear affordable, but if the company regularly issues new shares to fund losses, your ownership percentage and potential upside shrink with each round. Review the share count over several years to see whether it is stable, slowly rising, or exploding upward. A modest, well-explained increase tied to sensible investment can be acceptable. Constant large increases with little improvement in the business are not. Because markets and sectors evolve, the specific opportunities in each of the 5 categories will change from year to year. One year may favor cyclical companies recovering from a recession. Another may highlight small software firms riding a new technological wave. Rather than trying to guess which category will dominate next, build a flexible process. Keep a watch list for each type, update your research periodically, and add or trim positions as fundamentals and valuations shift. This approach turns your search for best stocks under $10 into an ongoing practice instead of a one-time gamble. It is also wise to check how each stock fits into your broader financial life. If you already work in a particular industry, owning several small companies from the same sector can concentrate your risk, because your job and your investments might both suffer from the same downturn. Diversifying across industries and regions helps protect you from shocks you did not foresee. Similarly, if you have debts with high interest rates or no emergency savings, tackling those issues first can do more for your long-term wealth than any clever stock pick. In the end, the most powerful advantage you have as an individual investor is the ability to be patient and selective. You are not forced to buy or sell on any specific day. You can wait for the price and conditions that make sense to you, guided by your understanding of the 5 types of promising under $10 stocks: the steady cash flow workhorse, the cyclical company in a temporary slump, the small but genuinely profitable growth firm, the disciplined turnaround story, and the solid international business with a low nominal share price. You do not need to own all of them at once. Even 1 or 2 well-chosen names held for years can meaningfully enhance your returns. If you approach this space with discipline, humility, and a commitment to learning, low-priced stocks can become a useful tool rather than a dangerous distraction. They can give you experience in analyzing businesses, deepen your understanding of how markets work, and in some cases, reward you with substantial gains as the gap between price and value closes. But always remember that the real best stock is the one that fits your goals, your risk tolerance, and your long-term plan, not the one that appears on a random list. Focus on building that plan first, then let these categories of under $10 opportunities support it instead of define it. Thanks for watching the video. Subscribe to our channel for more informative and finance-related videos. Thank you.